Well, hi, ladies and gentlemen. My name's Chris Weston. I am Head of Research here at Pepperstone, and we're going to be going through the facets of the financial markets, really to try and get you set up for the new trading week ahead. But before we do, I just want to go to the disclaimer for compliance purposes. And here we go. Take it away. All right. We're going to break up the program into 3 different sections. So if we can just show you exactly where we're going to go. So let's start off with a review of how things are setting. Obviously, we look forward as traders and market participants. We don't live in the past. But I do think they give us a sense of the platform that we've got for the new trading week. We'll be taking a lot of the thematics and obviously the price action into the new trading week. We're going to have a look at the landmines, the event risks that you need to have on your trader radar for this week that could cause some volatility. At least the market's going to potentially move off. A lot of what we're seeing at the moment is really flows orientated, whether it's in the options market, hedging of gamma positions, or whether it's people looking at low volatility and vol dynamic funds moving markets in there. But there's a lot of chasing going on. But the event risks do matter. They can cause short-term blips in the market, and obviously we'll be keying across those. We're going to have a look at those as well, and then we'll go through some charts just to show where the flows are going and the probabilistic situations for the new week ahead. But let's start with a review. Now, obviously, as we saw last week, it was an incredible week that came through in financial markets. I'm going to go through some charts that epitomise what we've been seeing. Now, if we start with the indices at the moment, one of the things that we saw on Friday was weaker data coming out of the US. And I want to bring up a quick chart here of... let's have a look at the 10-year Treasury just to start proceedings in the US. If I can find it. There we go. And I want to have a look at the 5-minute chart. So as you can see here, what we saw around 2 o'clock in the morning for us here in Australia, but coming out just after the cash market open, we saw a pretty weak University of Michigan confidence number coming out. We saw an ISM manufacturing number, which was very weak indeed, especially on the new order subcomponents and also the employment component. And what we saw in the 10-year Treasury is, and also a big collapse in real rates as well, is we saw yields trade 429. Down, probably into the lows around 417. And once we saw that coming through, we did actually see the US dollar really moving alongside that as well. You can see here the orange line, the US dollar came under pressure, which makes a lot of sense. If yields are moving forward on poor data, then we're going to see that. Now, I will say as well that we also saw, speaking at the same time, Christopher Waller, one of the Fed governors, probably one of the most important Fed governors. His comments have been moving markets, the last few months, and he was talking around the sort of movement in towards holding their balance sheet on much more shorter duration assets. And that's, again, maybe was part of the reason why we saw duration going bid and 10-year yields falling under a bit of pressure. We also saw Laurie Logan at the Fed as well talking about upside risks to concerns around funding markets. But all of those sort of things happened at the same time. We saw bond yields falling, the dollar fell, and that situation therefore had a positive impact on equity markets. As the discount rate fell, the US dollar fell, we saw a situation where risk assets really rejoiced. Now, that's an interesting one, because if you had told me at the beginning of the session that we were going to see poor data, bond yields falling, I would probably say that maybe that just takes us a little smaller step closer away from a soft landing into perhaps a hard landing, and maybe risk assets would come under a bit of pressure because of those poor economics. That obviously wasn't the case. And if we have a look at indices, what we've been left with was all-time highs coming through. Let's bring this back onto the daily chart. Let's move the US dollar situation there. All-time highs coming through in the German DAX. We're not too far away from it in the French market, the FRA 40, the CAC. We've got all-time highs coming through in the Euro stocks market there. I mean, this is an absolute breathtaking, blistering trend that we've been seeing. I mean, this is just the trend follower's dream. It makes higher highs, it breaks out. You can put Bollinger Bands, whatever you use for trend following, Keltner bands, and this just makes higher highs and higher lows all the way through. So the question is this getting a bit extended from those points? But various European markets looking pretty good at the moment. Bit of an indecision on Friday in the German market there, but you can see obviously a very, very strong price action. We've seen blistering form in the US equity markets, as we know. It's overlooked, this poor data. Bad news has been good news, especially in the tech side of things. You've seen the US 500, the S&P making new highs coming through. About 61% of stocks were higher on Friday. But it was a pretty quiet session last week. and then we sort of took it away and then rallied nicely. We've seen obviously the Dow making new highs, Nasdaq really gone for it as well. That's where the outperformance has once again been seen. The market which I think you want to have on your radar this week is also the US 2000, the Russell, so to speak. You can see on the weekly chart here that we're just testing up topside resistance into this. It's been in this kind of multi-month or multi-year sort of consolidation range, which we're breaking out topside there. So for the trend followers, obviously trends start by breakouts, and that's what we're looking for now. Can we see this kind of momentum move perhaps up into 2300? We don't know. Of course, we have no idea where this is going to go. It's not about predicting, it's about reacting and trailing your stop loss up. This could start to bull trend. This range that we've been in has been very compressed, and it looks like it's breaking out. So really positive to see that. Obviously in Asia, you've been all focused on what's happening in Japan. The Nikkei has just absolutely gone for it, as you can see there on the weekly chart. Through 40,000, very, very strong. Overbought, granted, but pullbacks are very limited in this market. And you've seen all-time highs as well coming through in the ASX 200. Yeah, a bit of a value market. People look at this for income purposes. You're probably not going to get an index in the world which has a better source of income from a dividend play than the ASX 200. So we always look at this not just on a capital return basis, but on a total return basis as well. And if you have a look at it on a total return basis, the ASX has been a pretty strong performer. But we've been seeing some strong breakouts there. Nice moves up, about 1.3% last week. It's really been Asia, Hong Kong, which has been underperforming a little bit. Now I think HK50 probably needs to be on the radar. It's probably stealing from the future here from some of the charts that I've had, but you can see that we're in this wedge at the moment. I think I'd be looking at short positions on a close through these levels. Back through the rising uptrend, and then maybe if we get a close through this low around the sort of 16,148 region, then maybe add to those short positions, and maybe we revisit 15,000 or so coming through. What else have we been seeing? I mean, obviously, you can take a step back. We've seen a little bit move lower in rates markets. We've seen a pretty mixed picture coming through in FX markets on the week. If we have a look at what we saw last week, we can saw in G10 the Chilean peso. I'm just going to take this down a bit just to make sure that we can get that all in the screen, make sure that we can see that properly. Might be able to. There you go. So we saw the we saw the Chilean peso up 1.4%. That was your best currency in the one of the sort of the main complex that we offer. The Mexican peso looks pretty interesting. That could be something on the radar for this week, given that we do have CPI numbers coming out later in the week. We can go through that in a second. The yen's found a little bit of form. That was looking quite good. And then on Friday, we did hear from Governor Ueda, who sort of pushed back a little bit on this near-term idea that we're getting closer towards their inflation targets. And it was the New Zealand dollar, one that I was actually expecting traders to buy dips in last week, which has been the underperformer. Obviously, we were expecting a hawkish hold from the RBNZ last week. We actually got a fairly dovish hold relative to expectations in that situation. Now, I'm going to go through interest rate settings before we go into the event risk, because we can look at positioning, we can look at expectations, and we all can actually look at market pricing, and that sort of plays into our risk reward probability. If we have a look at the swaps market, and this is kind of the central view of the market of where the collective see interest rates by a specific month. Now, if we have a look in the US, and apologies for doing this on Excel, but it's how we look at it. We can see that the March meeting is priced, we've got one base, we've got a 4% chance. So that's not going to happen, obviously. But we do see that the door is open. We've got one in five chance of a rate cut in May from the Fed, and the market is pricing that by June we've got a full 25 basis point cut. So that's when the door is expected to be open. 12th of June is when the Federal Reserve are, in the market's eyes at the moment, and this is dynamic, it changes all the time, expected to cut in the June meeting. And then by the end of the year, they're expected to ease by 89 basis points, or divided by 25, 3.6 cuts by the end of the year, which is not a million miles away from the Fed's dot plot projections. In Australia, we can see, let's go when we're fully priced. The June meeting is a live one. We've got about 50-50 chance there. The market's saying that there's a 72% chance that we get a rate cut in the August meeting, and then we're fully priced for September. So between really, September and August, as it stands, and we'll see what happens when the data comes in, that's when the market's looking. In the UK, we get the first rate cut really coming in for August. Puts us in nicely around sort of election time. In Europe, what have we got here? We've got the market's looking for probably June as well, so about an 80% chance of a rate cut by June. Going to be very interesting around that June-August period. There's going to be a lot of central banks potentially cutting rates, and then you can see by the end of the year we've got 4 rate cuts being priced in, 104 basis points into European swaps. Canada, well, when are we looking for the first rate cut? Again, really June. So there's a lot of central banks there that are really looking at it. Now. I think we can look at that. That's the market pricing, and if we have a look at what the sort of sequencing of rate cuts coming through, Switzerland, the Swiss central bank are expected to be the first one. Japan, the market's pricing in a small token 10 basis point hike to get them out of negative interest rates by the 25th of April, and you can see we're at this lively period through June and August. Okay, so that's set the scene. Let's have a look at the data that matters for the week ahead. I want to say, keep an eye on some of these AI names in the week ahead because, if we have a look at them, Marvell are going to be reporting this week. You can see, obviously, just a breathtaking move playing through. We've also got Broadcom. Now, Broadcom is one that I've got on my radar. For people who like movement, this is obviously just absolutely gone for it. It's a pure momentum beast at the moment. And you can see that in the rate of change. Very, very strong rate of change. Obviously, the best momentum indicator you can get out there. But really strong breakouts. It's just on fire at the moment. Now, what I will say is that Broadcom, who report earnings later this week, the market's expecting a 7.5% move on the day of earnings, as you can see here. So that obviously is a reasonable amount of movement that we're seeing. But look at the performance of the shares. They haven't had, apart from take out the quarter that we got back in August, they've managed to close up 11 out of 12 reporting periods on the day of reporting. So if you're looking for pedigree and a company that typically blows the lights out and does pretty well, I mean, some of these moves have been pretty good. So 11 out of the last 12, these shares have closed up. Fine, we're in a situation where the shares are absolutely romping at the moment, which tells you perhaps we're priced for perfection. But that's something we are watching very, very closely. And I think if you're having a look at NVIDIA, which has been the poster child of all of this, bear in mind that we do have the GPC conference that comes through, the GTC conference that comes through on the 18th to 21st of November. So anyone who's involved in the AI scene, anyone who's involved in the NASDAQ, for example, that period between the 18th and 21st when NVIDIA come out and unveil their products, tell people how their innovation's going, I think is going to be absolutely key. There's a lot of shareholders out there who want to buy NVIDIA. It's tough to do at these levels. We know that valuations are lofty, but valuation hasn't really mattered. Watch what happens when we get the NVIDIA GTC conference. I think that's going to be a really big part of that as well. But we do get some names coming through from Marvell and from Broadcom. And Broadcom's probably the stock that I'm looking at, given its pedigree, given the expected movement, given the trend that we've been seeing playing through. Okay, so what are we watching in terms of the big ones for this week? I've set the scene. It's taken me a while. But I think really, if you want to look at broad markets, it's going to come from the US side of things. And I think there's probably a couple of things we want to look at. One is the ISM services number. Now, why do I want to look at that? Because typically that's not a volatility event, but because the ISM manufacturing number was weak and we did see a positive reaction. I know there was other factors at the same time, but we saw a positive reaction across markets. It does suggest that if we were to see a big beat or a big miss relative to expectations, then you could see some life in the market. And again, look, we're looking at the services number 53, so it's expected to pull back a little bit from 53.4, so still a good expansion above that 50 level. But we'll be watching the employment component and the new orders component above everything else. I think that's really when you will look at. So the price is paid as well, given that services inflation is still very, very strong. I think this number, it's typically not been something I've been too concerned about holding positions over, but I am, given the reaction we saw from the manufacturing number, suggests that perhaps this could cause some movement if it has a material miss or beat. Jolts, obviously, if you're in a position where you're short US dollars or long gold, long equities, you probably want to see this number coming out below consensus of 8.89 million job openings playing through. Jobless claims, I'm not expecting any major changes there, but it's the payrolls number on Friday, which of course is the McDaddy of the economic releases this week. Now, again, what we're trying to find out is will bad numbers be bad for risk, or will it be good for risk because it's going to bring increased rate cut expectations and bring down long-term yields? I think that's going to be the interesting one. So what are we watching? 200,000 is what we're expecting there. That's the central case. That's a decent moderation from what we got last month. Predicting these numbers is obviously very, very hard to do. The unemployment rate, I think, is going to be where the market reacts most functionally. I think, I actually personally believe, and price will tell me everything I need to know, that if we were to see a higher number, then markets will de-risk. It's not going to increase rate cuts, and the markets will rejoice. I think a higher rate unemployment rate and the market de-risks in terms of what we've been seeing in equities. But I think the purest reaction there will come from the dollar, and certainly dollar yen is always a really good one to look at there. But you can see the unemployment rate expected at 3.7%. Average hourly earnings, always important. Markets looking at that to just moderate down to 4.3%, but that's really going to be down to the average week that we're going to be seeing. The other big thing that we need to look at in Europe, in the US this week, is Jay Powell's testimony. He's going to be speaking before Congress, both to the Senate. So the wider Senate as well, and I think that's going to be an interesting one. So, 2:00 for us later this week. I think that's going to be the big one there as well. Now, obviously, Powell can move markets if he wants to move markets. I think he's going to have a pretty neutral statement, to be fair. After what we saw from that last CPI number, there's really no reason to sort of, to be any more urgent on rate cuts. They want to see the next CPI print, which comes out next week on the 12th. And I think, he's going to have quite a balanced statement, which probably in theory could be quite a little bit US dollar positive. We'll have to see. But I think that's going to be another one that we need to look out for as well. I want to put this on the radar. This is an interesting one. We've got a CPI number coming out of Switzerland this week. Now, we're expecting that to moderate to 1.1% from 1.3% and core to come to 1% from 1.2%. This is significant. I know a lot of people, unless you're a currency trader, probably wouldn't be looking at this one. But if you are a currency trader, you have to have this one on the radar, because if this comes out, the market's already pricing about a 70-80% chance that the Swiss National Bank cut rates at the next meeting later this month. And that would lead the sort of G10 complex in this easing cycle. So psychologically, I know there's a lot of hedge funds looking to become really, really overweight on shorts in Swiss franc at the moment. And I think this CPI number could open the door and mean that psychologically the Swiss National Bank are going to be the first ones to potentially lead us up when their meeting comes out. When does it come out? On the 21st. Yeah, the market's already pricing that 70-80% chance of that happening. What else are we watching? We've got a UK budget playing through. I'm not expecting that to necessarily be huge fireworks. The gilt market hasn't underperformed too much. I think the press have pared back a little bit expectations that Rishi Sunak and his Chancellor are going to come out with a blockbuster budget that's going to win votes. I think people have pared back those situations. There's not really else much to watch out for there. Let's have a look at Europe. We talked about what was happening in rates. The market's not pricing in the first cut till June. The ECB have been very, very, very upbeat in terms of, they're very cognizant of putting the market onto a place where they're going to be looking to cut rates in June. We've got an ECB meeting coming through later this week on the 8th at 12:15 midnight Eastern Standard Time. No one's really expecting any changes in any of the rates that they've got at the moment. I don't think that's going to be the case. What I think you probably want to have a look at, if we have a look at euro dollar, is this kind of trading range at the moment. That's what I've put here is the projections. Now, the ECB will be running their new economic projections, and I think that could be really worthwhile watching because it shows an element of intent by the central bank. Now, we're expecting their current guidance for 80 basis points for growth over this year to be downgraded by about 20 basis points. Maybe a little bit of a tweak higher for next year, but really for this year, they're going to revise their growth estimates down. Their headline CPI number is expected to be revised down from 2.7%, which was the previous recommendation or estimate in December. And now they're looking for that to come out at 2.3%, and core just massaged down to 2.6%. So downgrades in their estimates for this year, but it's not going to be enough to open the door to an April rate cut, and I think the market therefore is going to be fairly well contained in terms of what we've been seeing. Now, if we have a look at the sort of move, I think for the week I want to lean up into shorts into 109.30 around those kind of areas, and into 107.58 I think we're looking to buy, and I think it continues to trade a range. Now, why have I chosen those levels? If we have a look at euro dollar 1 week implied volatility and extrapolate the sort of break-even level for the option straddle, that's where the market is saying with about a 70% level of confidence that euro dollar should trade into. So I think we're using the options market here to tell us what they expect with a certain degree of confidence. And so therefore, we're not expecting any major surprises from the ECB. they've guided us to June. I don't see them opening the door to April. So I think this is kind of the range that I've been playing. But for now, FX volatility has been shot to pieces. We all know that's been the case. And partly it's because euro dollar is just trading in this sideways range. So I'd love to see this trading trend in a more powerful fashion. Which way does it go? I don't know. I suspect it to the downside, but it's going to take a more bullish or hawkish Jerome Powell to play through there as well. The other thing you want to watch in China this week, tomorrow, we've got the National People's Congress playing through. And the market is expecting new economic projections from the government here. What are we looking for? About 5%, around 5% for the growth targets. That's what they got last year. They beat it by about 20 basis points. They were targeting 5% last year. They came out at 5.2%. Their fiscal deficit as a percentage of GDP should be around 3% as it was last year. They'll probably beat that one as well, but I don't think they're expecting any major changes. And also their inflation targets and also special bond quotas as well. But given what we've been seeing in Chinese markets, that's something we are watching quite closely. Now, the other one is on the weekend, we will be getting CPI numbers. The question is, that comes out on a Saturday, midday, so is that going to be a gapping risk for traders who go into Friday's trading session? I'm not expecting it too much. The market's expecting it to have to rebound after 4 months of negative price pressures on consumer level. They're expecting that to rise by about 30 basis points in the month of February. Producer price inflation still very poor and falling at 2.5%. Obviously, that plays into companies' margins. But I think it's going to be the MPC meeting that's going to get arguably the lion's share of press. What else? Put Japan on the radar, and then we'll go through the charts quickly. This is a big one. Tokyo CPI. Now, that's important to me because we saw last week an above consensus national CPI number. The national number was for January. The Tokyo one here is for February. So this leads the national number. That's why we look at this one quite closely. And if we have a look at the headline numbers, the market's expecting last month's to be revised up to 1.8%, but then this number for February to be at 2.5%. And if we have a look at ex-food, ex-energy, or the core, expected to stay at 3.1%. Now, Governor Ueda will be speaking this week, along with other Bank of Japan meeting officials, and there has been a lot of noise recently in Japanese media about reaching their 2% inflation target on a sustained basis. Now, that has big implications for the yen. One thing I will say is the idea about extrapolating a move away from negative interest rates by one hike, maybe two by the end of the year, or what other people are thinking is the beginning of a rate hiking cycle. Two very different things, have very, very different meanings for the Japanese yen and obviously the Nikkei coming forward. But do keep an eye on this CPI number. And we've also got labour cash earnings. The other big one for your date for your diary, we can talk about it next week, is the 15th of March. We get the spring wage negotiations in Japan. The Bank of Japan have said they're watching this one very, very, very closely indeed. We're expecting about 4% wage growth earnings to come through. But depending on what happens there, that could be the trigger point then for the Bank of Japan to come out of negative interest rates by raising rates by about 10 basis points either in March or where the default situation is at the moment, which is April. Anyway, they're probably the big ticket items to focus on. Australia, we've got GDP, but backward looking. We live in the future, as we talk about, so not too concerned about that one as well. So euro dollar, we've got this range that continues to be the place. I continue to want to trade that. Cables as well. I mean, we've just seen such staggering business on Friday in the pound and in cable more specifically. Most of it now looking to go short. Clients are now loading up on dollars at the moment. Nothing really in the longer term timeframes that gives me any kind of really strong belief about where it's going. I think in the Q, trade the range. There's nothing really. It's just trading sideways and then not playing into the low volatility environment we've been playing. Dollar Swiss, I think I'd probably this is one I favour to the upside. I mean, obviously it depends what happens with the Swiss franc, with the CPI numbers, but I'm really starting to warm to the idea of laying into short positions in the Swiss franc. Maybe against the Noki could be an interesting one because we'll have to have a look at what happens in Brent crude. I can have a look at that in a second. But the Noki's getting that tailwind now from a stronger Brent crude price. And I think if we get that this coming under pressure, then I think that leads us lower. What else are we watching? Back to the indices. I mean, for me, this is I'm either long or I'm neutral. I can't go short these markets at the moment. I know we're about 13% above the 200-day moving average, but that's not really overly stretched. I mean, we can get to about 18%. I think historically we're 18% above the 200-day moving average before things get really, really heated. And I've had people say, market participation has been really poor. Look at market breadth. If you have a look at this chart, you can see that 25% of stocks are making 4-week highs. If we're really interested, we'd be back at these kind of 72% levels. The number of companies above their 50-day moving average. We've got a market well above its 50-day moving average, but only 69% of constituents are doing so as well. So the breadth has been pretty poor, but look, the breadth has been poor for a long time, and it's really given me absolutely no signal to take short positions or look at contrarian positions at all in this market. So it's something I'm aware of. I'm definitely not trading it. A lot of what we're seeing is options flows, a lot of momentum strategies chasing the market. And, for me in the index world at the moment, until I can see higher volatility playing through, I think the trend is your friend. I think if we were to break 49.21, which is a bit of a stretch, then I think, that's going to be the trigger then for a lot of de-risking to play through. But I still like the equity story. I still like it higher. I still like, what I'm seeing in risk and, what I'm seeing in AI and semis at the moment. Gold, let's have a look at gold. Breaking out, we're at all-time closing highs in gold. If we're looking at the data for it this week, look at the services number, ISM services number. We want, obviously, if you're long gold, you want that to be weaker because then that's going to have an effect of pricing and more rate cuts, and you're going to see real and nominal yields coming under pressure. But look, it couldn't do it back on December 4th. You had a really big spike up, came back in. We tried to take it out around these kind of late December times, but we've managed to hold it now. That's bullish. Obviously, it's bullish. There's really no other way to look at it. I would be looking to put buy stop orders above the market and hope this kicks on. That's why you have buy stop orders. Momentum begets momentum. And you want to buy high and sell higher, basically. So you're leaving stop execution orders above the market 20, 80, and hope this continues to run playing through. But obviously that's going to respond on a not so hawkish Jerome Powell later on this week, and some of the data coming in weaker than expected. Never good to hope for weaker data because it shows that people are not as prosperous, but ultimately that's what the market is going to key off. Let's have a look at some of these cryptos at the moment. Bitcoin Cash over the weekend, absolutely flying. People want movement. People want range expansion. That's been a good one. From our coins offering, Ethereum Classics just absolutely ripping at the moment. Bitcoin itself just been a little bit in the doghouse. We saw a consolidation 4-day period after an explosive move up. I know everyone's talking about the inflows into the spot ETF, the likelihood of an Ethereum ETF coming through. You've got MicroStrategy buying more coins. There's a whole host of reasons behind it. I mean, I could look at the options chain and see massive call buying, well out of the money at the moment. And as markets are moving up through the strikes, dealers are having to hedge their gamma by buying the underlying, and that's just pushing price up as well. And actually, for the volatility in the market, it's actually not that volatile. The close-to-close percentage changes are rarely above 4%, and that's statistically what we're talking about in terms of volatility and how that's sort of moving away from the mean. So I like this higher. I think crypto goes higher. To be honest, I think Bitcoin's a buy it through 6,400, 64,000. I think Ethereum's a buy. I think they continue to stay long these cryptos at the moment. I've got one question from Graham. Thank you for your question, Graham, about the lithium miners of late. I'm not an individual stock guy, and I've been looking at some of the AI names in the US, and that's really because we've been seeing so much business in those names that we've been obviously very much interested in them, and the impact that they've had on the broad market suite of offerings means that you kind of have to be involved, and there's a big macro play that's involved. But I haven't necessarily been looking at the lithium plays. I know everyone's been talking about them recently, so maybe that's something that I can do some work in and share with you next week, or I can go back into the comments later on and do something. But I'm not going to. For now, it's not something I'm overly qualified to give an explanation on. So I'll probably steer clear of that one. Do a bit of digging on that one. So apologies for that, Graham. Anyway, So that's the week ahead. That's the week that we've been. For the week ahead, we've obviously seen risk. Really, we're in a very strong position. I think pullbacks remain buying opportunities. I still stay fairly constructive of what we've been seeing playing through. Big ones this week are going to be really focused on the US, where we're going to have non-farm payrolls and POW. They're your big ones there. The other ones are going to be more sort of idiosyncratic to markets around them. The ECB, I forgot to say the Bank of Canada. They're obviously going to keep rates on hold, but we'll have to see with what the statement says relative to the pricing in the curve further down. We've got the People's Conference in China, so watching out for those growth targets and see the statement of intent from them. And there's a few other bits and pieces around Japan and the UK budget that we need to look at. So onwards and upwards, we're seeing the charts we like. Let us know how you're trading these markets at below.